Welcome to Financial Reporting Conversations, brought to you by Basford Consulting.
We're here to make the unknowns and knowns of accounting, auditing and climate standards known, so you can avoid the blind-threading mistakes and do financial reporting better.
Each episode will unpack what the standards really say, what they mean in practice.
Whether you're a preparer, auditor, director or litigator, our aim is to help you get it right. Hello and welcome to Financial Reporting Conversations. Wayne and I have been working on an IFRS 3 business combination course on iSpring lately, and I have to say, it's turning out to be a really long course. We thought our IFRS 15 and IAS 36 courses were long, and they were, but IFRS 3 was on a whole new level. And that's because there are just so many practical issues that arise in business combinations. And what has really come to light for Wayne and I, especially when you start building a structured course, such as the one that we're doing, is that the complexity begins well before we even get into IFRS 3 and apply the acquisition method. People often think IFRS 3 is just about identifying the acquirer, determining the acquisition date, measuring consideration, and recognizing goodwill. But in practice, before you even get there, there's already a whole raft of issues to work through. And one of the most common threshold questions is, are we even applying IFRS 3? And that sounds like a really simple question, but it's not. And that one of the big issues is that, is it actually a business or is it an asset acquisition? And then there's another issue we frequently come across, and that is what we often refer to as top hats. These are structures that are also extremely common in both private groups as well as listed. So we'll talk about those two issues today. Wayne, let's first talk about asset versus business acquisition.
Thanks, Judith. So really passing it back to you. What is the difference in the accounting for this is a business combination and it's not a business combination. I've just gone and bought an asset. So what's the difference in the accounting? Yeah,
so that's a great question. We should start off with. The accounting is completely different. So in the business acquisition, you have goodwill, you recognize goodwill. You will have to fair value all the assets and liabilities, and your transaction costs, which quite substantial in a lot of case transactions, you need to expense them straight away. With your deferred taxes, there is no initial recognition exemption for business combinations. And so you have to apply IAS 12 and recognize all your DTAs and DTLs. And so also another thing to think about is if you've acquired the business acquisition using shares, then you need to the subsequent accounting for those is applying IFRS 9. So if you're issuing a variable number of shares, you could end up with a financial liability. There's also a lot more guidance on what you have to do for contingent considerations. Applying IFRS 3 is very complicated, and that's just not on day one. On the subsequent accountings, you've got goodwill that you have to keep testing for impairment, and then you've got, if you've got contingent consideration or financial liability, you need to keep remeasuring them. Whereas for an asset acquisition, it's a lot more simpler. Basically, it's almost you're applying a sort of a version of IAS 16 where you just purchased an asset, you get to capitalize all your acquisition costs, so all your transaction costs gets capitalized, and you get to use the initial recognition exemption under IAS 12 for deferred taxes. And also, if you pay for shares, that is a share-based payment, and that is under IFRS 2. And if you're issuing shares, that's just equity and won't get remeasured, and in IFRS 9.
I think in summary, Judith, you're telling everybody, if they can, make sure it's an asset acquisition, really avoid having to go into business combinations. So from the preparers listening to this, people should be trying to argue it's an asset acquisition. For the auditors listening to this, be very aware there's a strong bias incentive to argue it's an asset acquisition, whereas if you read IFRS 3, it's really a business combination. So
yes, absolutely. I mean, a lot of the issues that we also look at is, like I said, before even we apply IFRS 3, is this whether it's an asset or whether it's a business, which standard we apply.
Okay, so simply, what defines a business and what defines an asset, and how grey are the boundaries between those?
Yeah, so IFRS 3, very simple. If you have a business as defined by IFRS 3, you need to have inputs, processes, and outputs. So those are the words in the standard. How you apply that can be quite judgmental and is very great. I mean, if you've got a business and you're making sales, you've got customers, then, clearly it's a business. If you've got like a bakery, your inputs are your flour, your butter, your milk, and, your processes is your recipes, and, you've got outputs, it's the bread, and, you're making sales to the customer. Whereas, if you've got an asset acquisition, it could just be a building that you've put in in an entity. It's not whether it's in a company or if it's not in a company that defines whether it is a business or not. And so if you've got just, or some junior explorers, if you just acquired a tenement, that is just an asset that you're just exploring, that's just a license that you've acquired. So that's an asset. You don't have any outputs or processes.
I've always thought part of the litmus test is, does it come with a workforce? You buy an asset, conceptually, I buy a car. I can run that car as an Uber business, but it doesn't come with an Uber driver. It doesn't come with a workforce. So there's lots of issues. Most assets can be used to produce outputs. But a usual litmus test is, does it come with a workforce, or can you quickly turn a workforce on? A lot of stuff that we've been looking at recently are mothballed mines. I buy a mothballed mine. Is that a business? And as all our clients will horribly remember our phrase is, it depends. How quickly can you get the workforce on? Is it ready to go? Could you put in a contract miner? But it is a big difference. If you buy a mothballed mine, is that a business? Recognize goodwill, recognize all the fair value, recognize the deferred tax, really worry about the contingent consideration that comes with dependence on JORC, dependence on production? Or do you argue, no, all I bought was an asset, let's account for it under IAS 16? So going on, I'm talking the traditional way of I used to view assets versus business combinations. So now we've gone and introduced this new concentration test, which I know you've been having great debates with preparers and auditors. So would you like to talk us through the concentration test and problems that you've been seeing with people not managing to meet that threshold?
Yeah, so I think the concentration test was meant to be a shortcut method that was meant to, since it's so great, it's meant to be easier, and it's not meant to be a very determinative sort of back of the envelope, calculation. And, if you meet the asset concentration test, then it's an asset acquisition, then you don't have to apply IFRS 3. I think that was the purpose of the introduction of that test. But as you mentioned, we've seen a lot of issues in terms of applying that test in practice. And so basically for people who are not familiar with the concentration test, is if in the guidance it says that, if you've got a single identifiable asset that is the fair value of that asset is substantially all of the fair values of the assets you acquired, then it's an asset acquisition. So it can be one identifiable asset or a group of assets that have same risk characteristics. So, there's two pinpoint issues that we've been debating with our clients or helping our clients. One is what is substantially all. So they actually did not define in the standard what substantially all is, and that's because substantially all has been used in other IFRS literatures, and typically it's actually 90% or more. So basically it's pretty much the fair value of what you've bought is that asset. And the second thing is, what is a group of similar assets and how you sort of group, whether you can group more than one asset together. So, we've talked about a mothball mine. The standard says that, if you've got one asset, two tangible assets that they're glued together, that you can't physically remove, then you can treat that as one asset. So with the mothball mines where, everything is a lot of the the infrastructure is glued to the ground, then your whole mine can be one asset. So even, I guess we're seeing clients where, we've got an acquisition, it's a mothball mine, but everything has been glued, is all attached to that mine.
I do think you'll upset all the engineers to say that, to even envisage that we glue things to our mines. We certainly put it into foundations. We pile it. We have crushers. We have mills. We have driving equipment that is, you can't move it anywhere else. I think it's not movable. We've definitely seen real instances where there are movable kits. There are jumbos, there are mining equipment, there's mobile generators. Now, from your euphemism, glued to the mine, these are movable pieces of kit. So am I allowed to say, well, I bought the mine, I bought the mineral rights, I bought the crusher and the drift, and can I add on all of the lorries, the trucks, the diggers, the mobile generators, the mobile light banks? Would that fit your glued test?
No, unfortunately, those ones will have to be considered as not part of the assets. And I mean, instances where if it's really all mine, whether those things are less than, 10% of what you've bought, the fair value of those things, then you could get into the asset concentration test, but we've also had clients where, they've got all those things and they've got some stockpiles of inventory, and then we had to account for that as a business combination because not substantially all of the fair value is with all those sits within the immovable equipment.
I think more correct because, all the stockpiles, and we buy lots of stockpiles and on pad, etc. I think really it throws you out of the easy concentration test. Remember, it's the concentration test. I don't have to worry about inputs, outputs, etc. So more than 90% of it is your glued asset. Mm-hmm. But in a lot of cases, even mothballed mines, you fail that concentration test, and then you have to go into, is it a business under the normal inputs, processes, outputs of three?
Correct. Absolutely. And then the other issue that I've mentioned is what is similar risk characteristics of those assets when if you've got a group of assets. And the standards that it's actually quite, you need to segregate them in, it's almost as if you need to or each of those assets needs to be identical to be considered as, they don't use the words in the standard, but when you're looking at some of the guidance out there, it's almost as if that to be considered as a group of similar assets, they almost have to be identical. So if you've got buildings, if you've got a office block, and if you've acquired an office block, and if you've acquired a retail shopping center, that would be considered two different properties and two different assets in this asset concentration test. Or if you've got a 4-star hotel and a 2-star hotel, even though both hotels, they're separate, they're considered different risk characteristics because of the customer base of those hotels are different. And, the list goes on. And residential apartments and freestanding homes, those are separate in assets from applying this asset concentration test. So, I mean, it's the idea of this asset concentration test is really for those single, if you've got what we call corporate wrapper, you've got one big office block, and then it comes with it comes with tenants, and it comes with a management contract that usually would be classified as a business, but because, you just acquire one building, that building is 90% of the fair value. That gets you asset acquisition. That's what the test is designed for. And so there's a lot of friction when we're trying to, put like a lot of different other sort of transactions into and trying to get it into asset acquisition. And that is where sort of tensions and a lot of issues and debates we've been having. So as Wayne and I've discussed, whether you're a business or an asset acquisition is the first gateway question under IFRS 3. And, the accounting is completely different, whether it is IFRS 3 or asset acquisition, being asset acquisitions a lot more simpler. Another common area, let's move on to the next one we want to talk about today, is which is quite common across both private groups and listeds, is of what we call top hat accounting. And so typically what happens is the group sets up a new entity that's sitting on top of a group. And then it could be a restructure immediately because they want to sell the group. They're looking to go for an IPO. If you're finding this discussion useful, please take a moment to click like, subscribe, and share. It helps others in the financial reporting community discover financial reporting conversations and keeps you up to date with every new episode.
A top hat is, I've got an existing private company. I've got two existing private companies. I want to create a new company for some reason, to allow it to be sold to another entity, or typically to go IPO. So we throw this term around a lot, top hat accounting. And remember, if you're not in your mindset of IFRS 3 and is it a business combination, new co has gone and acquired old co or private co. We have now got 100% of the shares in old co, private co, and people's mind automatically goes, that's a business combination. Whereas obviously me and you go, no, that's not. That's top hat. So recognizing there's going to be people on this video listening to it that are not familiar with all of our jargon. So
yeah, and typically in these transactions, Topco, in order to acquire the shares in Oldco, Topco is typically issuing shares rather than cash as part of the transaction. So there is typically it's a non-cash transaction. So Wayne, how should we be thinking about accounting for these type of transactions?
Basic principles. You can't revalue internally generated goodwill. So just by setting up a new company and it issues shares to acquire the old company, you can't revalue all of your goodwill. You can't revalue intangibles. So it's got to be that type of area. You can get this more confusing because imagine it's at the same time as a fundraising or as an IPO. So you can actually see monies coming in. So external investors are paying money into the group, but it has got to be viewed from the existing investors of Oldco and who actually did Top Hat acquire the private company, the old company. And you can't revalue internally generated goodwill. It's not a business combination. And you end up with typically continuation accounting. So Oldco is continuing. You can't revalue goodwill. You can't revalue intangibles. And you can't lose your past. So Oldco's got a trading history, has got retained losses or all sorts of things. You need to disclose that as a comparative. So Top Hat accounting, you've set up a new co for Listco or a spin-off or whatever purposes, be aware it's unlikely to be a business combination.
Yeah, the key test is like whether the original owners, the shareholders, have lost control, right? If there's the whole, if the old co is ultimately still owned by the same shareholders before and after the transaction, there's been no change of control. And yeah, so there is.
Remember this whole area of new co's top hats. You wander into a world of either potentially thinking about reverse acquisitions, or more likely you're wandering into which we're not really going to cover on this call, business combinations under common control. So the same shareholders had old co at the start, and now they've created new co, but still control old co, and the only substance of the business is old co. You can't revalue or do acquisition accounting.
So do you see people getting this wrong? I presume the answer would be yes, if we're talking about
I think
confused.
So that's one of your rhetorical. You very likely deal with as many confused or mistaken questions as I do these days. I might view it more from a cynical auditor's perspective. So, do I see them getting it wrong? Yes, I do see it getting wrong. And for so many, it's like so many accounting errors. There's two reasons. There's either complete ignorance, which is a really common area of why people get business combination accounting wrong, or bias. So, and there is a future podcast we will do as my cynicism as whether Australia's actually adopted IFRS, and IFRS 3 is definitely one of the things. We're 20 years on. What's a business combination? A business combination is when I've acquired more than 51% of the shares in a business. How simple is that? For all those people my age and above, that's what I learned in CA in 1999 or whatever. A business combination, I've acquired shares. Now, IFRS 3 comes along with all these tests. It must be a business. It must be the relevant activity. It's nothing really to do with acquiring shares. That concept has not really been adopted in Australia, but so there's an ignorance. And then, as we touched on before, it's bias. And depending on my needs as a I can be a very clever financial controller. I have two bias. I want an easy life. I don't want goodwill. I don't want to recognize deferred tax. And massively, I don't want to go into your world of IFRS 9 on all the deferred consideration. This is a business combination. I'll pay you dependent on your future profits. I might give you some more shares. Somebody then like you says, I'm in IFRS 9, you've got derivative liabilities, you need to fair value all of those derivative liabilities through profit and loss. You're making my life really, really difficult, because if I say it's not, I say, well, that's just a contingent liability. It's a contingent liability under AASB 137. Nobody's actually told us what we do with contingent liabilities when we're doing an asset acquisition. So I'm just going to disclose I might have to pay a bit more. And when I pay a bit more, I'll very likely capitalize that as an additional cost of the asset. That's very tidy, nice, sensible accounting, but potentially completely wrong if I've actually acquired a business. You then get, and we've had this debates with our clients as well, I'm going IPO. I really would benefit from having a strong balance sheet. I would like as much goodwill. I want to revalue all of my intangibles, my IP, my licenses. I am driven to say that is a business combination. It's not a business combination. It's a top hat. You haven't done anything. It's common control. But there is a real incentive to argue quite vehemently it's a business combination.
So any tips for auditors before we wrap up?
Okay, so for auditors, stick straight back and always refer back to the inherent risk factors. Think about the inherent risk factors. Business combinations, it is change. They don't happen very often. So there's a greater risk associated with something that doesn't happen very often. They are complex. And definitely, as and when you attend the rest of the talk, speeches and course on IFRS 3, you will work out, even if you didn't think IFRS 3 was complex, I promise you it is. There's lots of judgment and subjectivity in, is it a business? Are they closely related? I love the idea, is it glued together? What are the outputs? So there's lots of judgments. And, you know, the other key factor when you come to do inherent risk factors is bias. And for the reasons that you may have got from my previous, there's all sorts of reasons why I might be biased to come up with the wrong answer. So when you're sitting there doing your ETD, when you're considering what could go wrong, it is, for the whole of IFRS 3, the first bit is ask the client to prepare an accounting paper through all the stages of IFRS 3. But the first bit they need to address, and you then need to be happy with, is it within the scope of IFRS 3? Is it a business combination, or is it an asset acquisition? And equally, if they're arguing it's an asset acquisition, I'm under IAS 16 or IAS 38, you need an accounting paper for them to say, yes, I've considered it and it doesn't have the characteristics of a business. We are the auditors. We do not make accounting judgments. The preparers are the guys that have to get IFRS 3 right.
The auditors will have to. But auditors will have to challenge those.
We apply the appropriate level of professional skepticism, and we know the risks associated with not applying IFRS 3 correctly. We know the risks of us incorrectly getting an asset acquisition or vice versa. So we have to get sufficient appropriate audit evidence to address the risk that we've got the starting point of IFRS 3 wrong.
Okay, thanks, Wayne. So in today's financial reporting conversations, we have highlighted that IFRS 3 isn't just about applying the acquisition method, although there are a lot more complexities there as well. But the complexity starts even before we get into IFRS 3. Is it a business or is it an acquisition, asset acquisition? Does IFRS 3 even apply? Has control genuinely changed? So these are the questions that we need to get it absolutely right before we move into IFRS 3 itself. So thank you everyone for joining us, and we hope you enjoyed this episode of Financial Reporting Conversations, and we hope you'll join us next time.
Thanks, Jude. Thanks for listening to Financial Reporting Conversations. For guidance on applying accounting and auditing standards, or to access our online training programs, please visit basfordconsulting.com.
Don't forget to like, subscribe, and share this episode with your colleagues and contacts. We'll see you next time, where we make the unknowns in financial reporting known.